2020 has been an incredibly wild ride. However, the year has given us more than the usual tax planning opportunities. I'm Emily Rubenstein, a tax consultant with Henssler CPAs Advisers. In this episode of Planning Priorities, I'll cover some of the things to consider as you weigh potential tax moves before the end of the year. Consider opportunities to defer income to 2021, particularly if you think you may be in a lower tax bracket next year. You may be able to defer a year-end bonus to be paid in January, or postpone collecting business debts, rents, and payments for services to push the payment of tax on this income until next year. You should also look for opportunities to pull deductions into the current year. If you itemize your return, payments made for medical expenses, qualifying interest, and state taxes before year-end would be deductible in 2020 and could make a difference on your tax return. When you itemize deductions, you can generally deduct charitable contributions, but the deduction is limited to 60%, 30%, or 20% of your adjusted gross income, depending on the type of property you donate and the charitable organization. 2020 offers a variety of ways to make contributions, as the normal rules have been enhanced. The limit is increased to 100% of AGI for direct cash gifts to public charities. Furthermore, the CARES Act creates a $300 above-the-line charitable contribution deduction for taxpayers who take the standard deduction on their returns. If it looks as though you're going to owe federal income tax for the year, consider increasing your withholding on Form W-4 to avoid a penalty for underpayment of estimated tax. Withholding is considered as having been paid evenly throughout the year instead of when the dollars are actually taken from your paycheck. Deductible contributions to a traditional IRA and pre-tax contributions to an employer-sponsored retirement plan, such as a 401k, can reduce your 2020 taxable income. If you haven't already contributed the maximum amount allowed, consider doing so. For 2020, you can contribute up to $19,500 to a 401k plan, or $26,000 if you're age 50 or older, and up to $6,000 to traditional and Roth IRAs combined, or $7,000 if you're age 50 or older. The window to make 2020 contributions to an employer plan generally closes at the end of the year, while you have until April 15, 2021 to make 2020 IRA contributions. Once you reach age 70 and a half or age 72 if you turn 70 and a half after 2019, you generally must start taking required minimum distributions, or RMDs, from traditional IRAs and your 401k plans. However, the CARES Act waived RMDs from IRAs and most employer retirement plans for 2020. If you have already taken a distribution for 2020 that is not required, you may be able to roll it over to an eligible retirement plan. And while you shouldn't let tax considerations drive your investment decisions, it's worth considering the tax implications of any year-end investment moves. For example, if you have realized capital gains from stock sales, you can offset some or all of those gains by selling losing positions. This just covers some of the basic year-end tax moves. If you collected unemployment in 2020 because of COVID-19, were divorced or separated, sold your home, or missed out on certain tax benefits that expired in 2017, you'll definitely want to talk to a CPA before year end. Give the experts at Henssler CPAs and Advisers a call. My name is Emily Rubenstein. Thanks for watching.